There's a retirement account that gives you triple tax advantages. Not double, triple. And starting in 2026, millions more freelancers can finally use it. I'm talking about the Health Savings Account, or HSA. Most people think it's just for medical bills, but used strategically, it might be the most powerful retirement tool available to any freelancer. In the next 8 minutes, I'll show you exactly how it works, why 2026 changes everything, and the retirement strategy most people never discover. Note: this information applies to US-based freelancers and self-employed individuals. Welcome to the Freelancers Wealth Blueprint. Let's dive into the HSA. First, what makes the HSA so special? 3 words: triple tax advantage. Benefit 1. Your contributions are tax deductible. Every dollar you put in reduces your taxable income. For freelancers paying both income tax and self-employment tax, this is huge. Benefit 2. Your money grows tax-free. Unlike a regular brokerage account where you pay taxes on dividends and capital gains every year, HSA investments grow completely untaxed. Benefit 3. Withdrawals for qualified medical expenses are tax-free. No taxes going in. No taxes while it grows. No taxes coming out. No other retirement account offers all 3. Traditional IRAs and 401ks give you tax-free contributions but tax your withdrawals. Roth accounts flip that, taxing contributions but not withdrawals. The HSA? Tax-free on both ends, plus tax-free growth. Now let me tell you about the 2026 game changer. Before 2026, you needed a high-deductible health plan to qualify for an HSA. That meant your plan needed a minimum deductible of $1,700 for individual coverage or $3,400 for family coverage. Many marketplace bronze plans didn't qualify because of how the IRS defined high-deductible plans. That locked out millions of freelancers. Starting January 1st, 2026, that changes. Under the One Big Beautiful Bill Act, every ACA bronze and catastrophic marketplace plan now automatically qualifies as HSA eligible. This is massive. About 7 to 10 million Americans who buy their own insurance, including freelancers, small business owners, and gig workers, are now newly eligible for HSAs. If you have a bronze plan through healthcare.gov, you can now open an HSA and start getting these tax benefits. You couldn't do that before. Let's talk numbers for 2026. For individual coverage, you can contribute up to $4,400 per year. For family coverage, the limit is $8,750. If you're 55 or older, add another $1,000 as a catch-up contribution. That means a 55-year-old freelancer with family coverage could shelter $9,750 from taxes every single year. Where can you open an HSA? Fidelity, Schwab, and Lively all offer HSAs with no monthly fees. I recommend choosing one with good investment options so your money can grow. Now here's where it gets really interesting. The retirement strategy most people miss. You don't have to spend your HSA money right away. In fact, the smartest strategy is to not spend it. Here's how it works. When you have a medical expense today, pay it out of pocket. Save your receipt. Let your HSA money stay invested and grow for decades. Then in retirement, you can reimburse yourself tax-free for all those old medical expenses. There's no time limit. A receipt from 2026 can be reimbursed in 2056. Think about that. You're essentially creating a tax-free investment account that can grow for 30 years. When you finally withdraw, it's still tax-free because you're reimbursing qualified expenses. This strategy requires discipline and good record keeping. But the payoff is enormous. Let me put some numbers to this. Say you contribute $4,400 per year for 20 years. That's $88,000 in contributions. If your investments grow at 7% annually, you'd have roughly $200,000. Now, assume you've accumulated $50,000 in medical receipts over those 20 years. Dentist visits, prescriptions, glasses, all the small stuff adds up. You can withdraw that $50,000 completely tax-free. The remaining $150,000? After age 65, you can withdraw it for any purpose. You'll pay regular income tax, just like a traditional IRA withdrawal, but there's no 20% penalty. Speaking of age 65, let me explain the retirement rules. Before 65, if you withdraw HSA money for non-medical expenses, you pay income tax plus a 20% penalty. That's steep. Don't do it. After 65, the penalty disappears. Non-medical withdrawals are taxed as ordinary income, but no penalty. Medical withdrawals remain completely tax-free forever. Here's another advantage. HSAs have no required minimum distributions. Unlike traditional IRAs and 401ks that force you to start withdrawing at age 73, your HSA can keep growing tax-free as long as you want. This makes the HSA a perfect complement to your other retirement accounts. Use your 401k and IRA for regular retirement income. Let your HSA keep growing. Then use it for healthcare costs, which, according to Fidelity, average $165,000 to $175,000 per person in retirement. That's right. The average 65-year-old will spend over $165,000 on healthcare throughout retirement. Having a tax-free account specifically for these expenses is incredibly valuable. One important warning about Medicare. Once you enroll in Medicare, you can no longer contribute to an HSA. You can still use the money you've already saved, but no new contributions. Also, Medicare Part A enrollment is retroactive up to 6 months. So if you're approaching 65 and still working, stop HSA contributions 6 months before you plan to enroll in Medicare. Otherwise, you might accidentally overcontribute and face a 6% excise tax. You can still withdraw from your HSA to pay Medicare premiums tax-free. Parts A, B, and D premiums all qualify, just not Medigap premiums. Let me give you the action steps. Step 1. Check if you're eligible. Starting in 2026, any bronze or catastrophic marketplace plan qualifies. If you have one of these plans, you're in. Step 2. Open an HSA at Fidelity, Schwab, or Lively. These have no monthly fees and offer investment options. Step 3. Contribute the maximum. For 2026, that's $4,400 individual or $8,750 family. If you're 55 or older, add the $1,000 catch-up. Step 4. Invest your HSA funds. Don't leave it in cash. Choose low-cost index funds and let it grow. Step 5. Pay medical expenses out of pocket when possible. Save every receipt. Let your HSA compound for decades. Step 6. In retirement, reimburse yourself tax-free or use the funds for Medicare premiums. The HSA is genuinely the most tax-advantaged account available to Americans. And starting in 2026, more freelancers can access it than ever before. If you found this helpful, check out our video on the 5 tax deductions every freelancer misses. Link is in the description. See you in the next one.